Thank you for checking out Real Talk Personal Finance. Shit's about to get real. Cashflow King with you today, and in today's episode, we have another listener finance review. This one's on Big Brother K, featuring Cube Crusher. Thanks so much, everybody, for tuning into the show. As always, we really appreciate it. If you feel like we've earned it, feel free to leave us a 5-star rating and review. And also feel free to share the show with your friends, family members, coworkers, strangers at the grocery store, whomever. We appreciate it. All right, with all that said, and without further ado, we don't have a lot of announcements for today's show, so we're really just going to get right into it. We got a lot of information to go through here. This is another listener finance review. If you missed the last one that we did on Cashflow Rockefeller Prince, feel free to go back and listen to that episode. But we had some listeners that had written into the show and asked, hey, are you guys still, can people still share their numbers and you give your 2 cents on what you think about their situation? And we said, sure. So we've gotten a couple of submissions. If you would like to submit your information to the show, feel free to send your stats to Real Talk Personal Finance at gmail.com. We don't need anything that's going to identify you personally, so you can use a code name, just like Big Brother K and Cashflow Rockefeller Prince. That's totally fine. Send us any information that you feel is relevant. And our quick disclaimer at the beginning, as always, we don't give any advice on the show. So some of our listeners have mentioned, hey, we need some non-advice advice, right? Because I understand we don't give any advice on the show. Everything we do is for entertainment and educational purposes only. Do your own due diligence and research, consult your own professionals, so on and so forth. All right. So with that said, and without further ado, let's welcome back to the show, Cube Crusher.
Still here, still alive.
All right. You ready for Big Brother K?
Yeah, sure.
All right. So Big Brother K sent in his information. He said that he really enjoys the podcast and was wondering if we still did these sort of little listener finance reviews. And so I said, yeah. So feel free to send your stuff. He sent a ton of stuff. So first of all, thank you, Big Brother K, for sending in your information to the show. I did go through the majority of it. There's some things you sent for individual holdings and things like that I really didn't go through with a fine-tooth comb because, again, we're not giving any investment advice or really any advice at all. We're not really going to talk about individual security selection or anything like that. We just kind of want to give the listeners a basic overview of your situation and kind of what you have going on, and we'll kind of talk through that as we go, and we want to keep it fairly general in nature. So with that said, let's go ahead and dig into Big Brother K's financial profile here. He lists the following under vitals. He says, male, 46 years old, recently married, 1 stepchild that's the age of 12, credit score 770-ish. Target retirement year is 2040, so that's about 16 years from now, if I'm doing my math right. And so that makes him about age 62. He anticipates part-time consulting during the first few years of retirement. And so I'm going to kind of do this section by section, and we'll kind of go back and forth on some different things. So not really a ton to say so far on the overview section. I like the credit score, 770-ish is excellent. Congratulations on getting married recently. And the only note that I had written next to the part-time consulting, which we'll get into later in the show, is he's planning on doing that during the first few years of retirement. And I wrote that that's good because we can look at potentially helping him to delay Social Security retirement benefits, which we'll talk about later. Any feedback on the vitals, Cube?
No, nothing really. Everything looks pretty good there.
Okay. All right, next, he has some information under the salary section. So just like the last financial profile we did, very strong income of $180,000, which, by the way, I don't know if I put this in here or not, but he did mention in his email that his wife is recently not working, not actively in the workforce at this time. They expect for that to change in the future, but for now, he's just providing his information, and basically her income would be kind of icing on the cake. So we have a salary for him of $180,000. Also, I don't know what it is with these 20% bonuses. 20% bonus eligible, so I'm assuming that's on the 180. 15% restricted stock units, redeemable in 1/3 tranches. He's putting in 13% pre-tax to his 401k and 4% into the Roth portion of the 401k. He gets a 6% company match, and he said at 50 years old, he plans to fully exercise the 401k catch-up provision. We'll come back to that. So gross, and I'm assuming this is per paycheck, $7,700. Net is about $4,200. And then he didn't put anything after this. It just says 2022 tax withheld and 2023 tax withheld. So I'm going to skip over that. So 180 salary, bonus and some stock options, 17% total going into the 401k, 6% match, 46 years old. What are we thinking so far?
Yeah, he's got a strong salary figure there, like you said. I guess everybody except for me gets bonuses these days. I need to go tell my employer that hey, everybody else is getting 20% bonuses. What the fuck?
Just get a little iPad and just have tip on there and start it at 20%. Would you like to tip me for my outstanding service here at the company? 20%, what is it? 22%, 25%, or whatever.
Yeah, 22, 25, and 30 are the only options I'm given.
Yeah, minimum 20.
But yeah, it looks like he's doing a little bit of tax diversification between with the 401k traditional and the Roth. And obviously the company match will be taxed when he takes it out. But yeah, everything seems pretty reasonable there to me.
Yeah, I think it's reasonable, but I'm not so sure I am overly thrilled about, I could take it or leave it really, but the Roth, I could make an argument either way. I like the fact that the majority of it is going pre-tax, and having that little bit of tax diversification, I guess, is okay, but, do we really need to have the Roth 401k exposure? I don't know. Maybe not. We will get into something a little bit later, though, that makes me more okay with his 4% Roth contribution to the 401k plan, because he does have, as we'll get into, a traditional IRA, and he having to deal with the potentially the backdoor Roth IRA and the aggregation rules that could muddy the waters a little bit on that. So, if he wants to put some money into the Roth portion of the 401k instead of putting additional dollars into the Roth IRA, which we'll talk about, I guess I could get on board with that. So nothing overly crazy there, but I would be more inclined to do the pre-tax personally.
Also, doing the pre-tax, it's going to be pretty close on the figures, but now assuming that he will be married filing jointly, if he is maxing out, it seems like his 401k, and he does it traditional, depending on other, if they use the standard deduction, or if they itemize, it can, it could almost be pretty close. Also, I know he has some real estate stuff, but and honestly, I don't know exactly all what's going on with that, but just looking at it from a salary standpoint, he could almost be eligible for a Roth IRA for him and his wife then, if he was doing it all pre-tax.
Right, and that could open up the door to direct Roth IRA contributions. Yeah. We're probably getting a little ahead of ourselves, but yeah, that could open up the door to direct Roth IRA contributions, which means he doesn't have to fuck with the backdoor Roth IRA, which makes his life easier. And so for those reasons, Big Brother K, that's something I would take a look at, to Keeb's point there is, maybe looking at that Roth 401k and flipping that to pre-tax, depending on what everything else looks like. Because, yeah, if he's going to be married filing jointly for 2024, basically once you cross over 228, you start to enter the phase out. And then once you get over 240 for modified adjusted gross income, you're pretty much, you have to go the backdoor method. So I don't know how recently his wife lost her position and if she's going to be working again soon or not, or what that looks like. And so there's a lot of variables there as far as that goes. But that would be something that that I'd be thinking about.
To me, in an ideal world, if you're maxing out your 401k traditionally, then that opens up another. What are the limits now? Is it 6,500 a person
for Roth? Seven. Yeah,
so that opens up another 14,000 that you can invest if you want to, because you can do it for both you and your wife.
Correct. Yeah, and then once he hits 50 in a couple years or 4 years, then it jumps up to 8.
Yeah, and then also at that point he would for sure be deferring enough if he's going to use the catch-up provision, because that'll be another, if he's putting it all pre-tax, another good tax break for him to use to get that income down lower.
Yeah, unless they end up reverting back on the whole catch-up over a certain income level having to be Roth and all that kind of shit. There's a lot of stuff going on with Secure Act and whatnot, but that's the other thing you mentioned about the company match being pre-tax. We'll assume that's the case, because virtually all plans, from a practical standpoint, that is still going to be the case. But starting in 2024, they did, with the Secure Act, I believe it was 2.0, essentially, pass something where if they amend their plan and the plan is updated, and an employee if they're putting in Roth contributions to their plan at work and they want the employer matching contributions to also count as Roth, then they would have to include that in their income, and technically they could do that if they wanted to. From a practical standpoint, I think not a lot of plans have done that. Probably virtually none of the plans have done that, because if you think about it, and I think I've talked about this on another show a while back, you have an employee education component where you have to educate people that that's how it's going to work. And then you also have to educate the people in the plan administrators and HR folks for the employer. Then you actually have to get the plan document amended. And, then there has to be the administrative and record keeping component that allows for that to happen, and tracking that separately. And so there's a lot of shit that needs to happen for the employer match to be, or a portion of it to be, Roth. So I don't think that's the case, and I do think what Cube said is correct for all plans, but just for the listeners, just know that could change in the future. So if you are putting in, let's say, for example, all of your contributions to your 401k at work as Roth, and they're all Roth 401k contributions, and your plan allows for it, eventually you might be able to tell them, oh, by the way, when you do my match, make that Roth as well. And yes, I understand that I have to include that in my income, but I'm cool with that. Like, we are getting into a point where we're already in a point technically where theoretically that can happen. From a practical standpoint, it's probably not for most people, but it can. All right, so on the salary portion, again, good, strong salary. Consider, I think if this is me, I'm considering more pre-tax for the reasons that we talked about.
Yeah, I would agree. It might open some other investment doors for him.
Okay. All right. Next, he goes on to primary bank account, which I'm going to assume is his personal account. There's some things, I like the way he labeled some things, but there's also the way some of these are labeled. I had to make some assumptions. So on the primary bank account, he has a CD ladder, as he calls it. And this kind of cracked me up a little bit, because he kind of reminds me of me in a way, right? Like, I have a million different accounts, and I know Cube Crusher likes to make everything simple, and I've gone through an effort to try to simplify things, in the past few years myself. But just having, a bunch of different accounts for different things and whatever. And so this kind of cracked me up a little bit, because he has 3 different CDs on this CD ladder. So he has a $2,000 2-month CD, another $1,000 2-month CD, and another $1,000 2-month CD. I don't know what the rates are that he's getting on these CDs, right? And maybe in a lower yield environment, it would make more sense to ladder them if you could pick up some additional yield that way. But I would venture, and again, I'm just kind of spitballing here, but I would venture to guess that the rates on these probably can't be more than 5%-ish or so, give or take. And so one of the things from a practical and simplification standpoint, if it were me personally, I would just take the $4,000 and just put it in a high yield savings account, or maybe put it in one CD that's giving you a competitive rate. Unless you're really like, how much additional yield can you truly be picking up 2-month clips at a time on these nominal dollar amounts? And I'm not saying this to poo-poo on Big Brother K. I think it's cool that he's doing what he's doing, but I think it might be creating some unnecessary complexity. What do you think?
Yeah, I think I agree 100%. It's like, yeah, like, Big Brother K, why are you wasting your fucking time with these? It's kind of what goes through my mind. It's like, I guess maybe he can, like, get one extra Busch Light at the bar. every 2 months or something. But
I mean, 5% on $2,000 is what, $100 divided by 12 months, right? This is overly simplistic. It's $8.33, and we're doing this for 2 months. So we're talking about 17. Did you say Busch? Can you get Busch Light for 17? I don't really drink anymore. I don't know what you can get. You know what? This is a funny side story. I almost signed up for fucking, what is it called? Walmart Plus the other night. I had to get an SD card, right? I'm going off on a tangent here.
Oh, yeah. Then you go to the checkout and they say, hey, you can get it for 50% off.
Correct. But they wouldn't give me free shipping, whatever, until I spent $35. So what did I do? Try to hack the system. I ordered 2 SD cards, did not fall for the Walmart Plus the 50% off. When I get those, I'll probably return one of them because there's free returns, and then I effectively wasted my time, but also got free shipping on effectively the one card that I'm going to keep. But yeah, anyway, where I was going with this is, with going back to the beer thing, at one point, I'm laying in bed, right? I'm fucking trying to order this thing, and I'm like, okay, I had like M&M ice cream sandwiches. There's like a 4-pack in there. I'm like, and they have Bud Light, like 18 bottles. I'm like, whatever. What if I add one of those to the cart? But then they want me to do local pickup. And I'm like, well, I'm an idiot. Of course they're not going to ship ice cream and fucking Bud Light. But I'm just sitting there trying to avoid getting suckered into this whole 50% Walmart Plus thing, and at the same time trying to get free shipping like an idiot. And I probably should have just went to bed, got an extra 30 minutes of sleep, and called it a day. So anyway, it just made me think of that. But yeah, we're talking about literally a few dollars here. I mean, I would wrap them up and put them in one account if it were me.
Oh, absolutely. Well, see, I was wondering, because it looks like he has those 3 CDs, and then the 4,500, I assume, is just in a checking account that is not including those. Is that what you were assuming?
Yeah. So I'm looking at it as, hey, his primary stuff is $4,500 in his checking, and then essentially $4K in these CDs spread across 3 different 2-month CDs, 2,000, 1,000, 1,000.
Throw it on the fucking checking account and go on with life.
No, I wouldn't even say that. Like, if you want to earn a little bit of extra yield on the CD money, that's cool, but just put them in one high yield account or something. You don't need 3 CDs. Put them in one CD or put them in one high yield account or something. Or better yet, find and you can go online and Google these online, like high yield. They have high yield checking accounts out there, and they're all a little bit different. But like, I use one where they cap it at $10,000. And yes, you have to jump through a couple of hoops, but it's pretty easy to do. And they'll pay, depending on your usage, 3, 4, 5% on a fucking checking account, right? Which is, I don't want to say unheard of because they're becoming more and more common, but it's not very normal for people to earn money on a checking account. So just like they have high yield savings accounts, they also have some sort of equivalents out there for these high yield checking accounts, if you will. So that might be an option. Wrap it into one, jump through a couple hoops and maybe get better interest. Or if you like the split because you don't want to see everything in one account, okay, cool, keep the $4,500 in checking and maybe take the $4,000 and put it in a separate account, but don't have 3 separate accounts. Put it in one account. Fair?
Yeah, I mean, yeah. Well, yeah.
I mean, 4 accounts for $8,500. Even Cashflow King loves his different accounts, but like, that's just too much. Too many accounts for that amount of money, I think. So that would be our feedback on that section. And we're not trying to beat you up. We're having some fun here. So we're not laughing at you. We're laughing with you. And part of it, when I'm laughing, I'm thinking, yeah, I used to do this shit too. You know what I mean? So like, it's all good. Let's see. Retirement section. Okay. So first thing he lists under retirement accounts, traditional IRA, $291,000, which I think is awesome. But then in parentheses, I wanted to pull my hair out, $63,000 in cash, which is about 22% of it. So I have a little note in the margin here with some question marks and exclamation points. Why? Why do we have that?
Well, I'm going to give Big Brother K the benefit of the doubt.
Oh boy.
I'm hoping that the $63K that's in cash he has in, one of the short-term government bond funds that's yielding, whatever, 5% roughly right now. If not, I would put it in that instantly. If I were him, if he wants something that he feels is, more liquid or okay, I don't see anything I want to buy right now. I don't know exactly how, what his investment style is. I can kind of tell a little bit by, all of the stuff that he sent us. But yes, I would agree I wouldn't have it just sitting in cash. if you want to sit it in some T-bills, a T-bill ETF or something for a little while, you know, I think that that's okay. I mean, you're looking at what? You're looking at, yeah, roughly 20% or whatever. You know, assuming who knows where the other 80 is. I guess he did send it to us, but I was trying to decipher all the screenshots that he sent, but and I'll have to pull those back up and might be able to figure it out. But yeah, if it's cash, Big Brother K, we probably want to put that into some T-bills real quick.
Or just, I mean, again, do whatever you want to do. If you feel like you need to have a cash position for whatever reason, I guess that's fine. But at 46, I don't know. I'm full throttle investing the money, not in cash, personally. I mean, again, non-investment advice, but do what you want to do. But he did mention in one of his emails, I think, about a rebalance coming up, and he was looking for what sounded like advice. And again, we don't give advice, so we can't really tell you where specifically to put it. Like, I'm not going to give you ticker symbols and shit. But whatever you decide for your investment strategy, I would certainly say you want to get it invested. And now, if your investment strategy calls for a 22% cash allocation, number one, I would question that investment strategy. But number two, you know, I would get it fully invested. But if nothing else, like Cube said, if you're going to have it in cash, put it in something that's yielding something, and hopefully it already is, some type of money market or money market cash equivalent that has a little bit of yield. It's not paying, you know, nothing.
Yeah, I would be okay with that. Of course, we don't know, too. This could be, he could have just, you know, well, he has his current 401k, so I guess he didn't switch jobs super recently, but, you know, this could be
rollover.
Something that, right, that,
yeah.
And he rolled it over himself, and he's been investing in chunks instead of investing it all at once, because some people do like to do that. But yeah, I would say that if it's sitting in cash at old Chucky Schwab earning about 0.01%, we probably want to do something with that. That's some non-advice that
yeah.
You know, you're kind of letting it sit there. I mean, it's pretty easy if this is something. I guess it doesn't say it's. I know he has a self-directed IRA as well, but if he's doing this himself, it's literally a couple clicks of a button that you can at least get 5% on that while it's sitting there, and then if you decide, you know, that something gets attractive and you want to buy, or the market goes down and you're ready to put some of that to work in the market, then you can always click a couple more buttons and buy.
It almost sounded like that might be what he's waiting for. Again, we don't know the origination of these funds, if it was always in cash, if it was a recent rollover, if it was he sold off a portion of his portfolio and now it's just sitting there and he wants to get it redeployed. But, I mean, all realistically, we're looking at this. He's 46. He's probably not touching this money for a minimum of basically 14 years, right? He'll be 60, so call it 59.5-ish or later. And he's in his target retirement year, based on what he told us, he's going to be age 62 anyway, right? So, I mean, that's even longer. What's that? 16 years from now. So, like, I don't see why that money wouldn't be fully invested. I don't know that it needs to be in cash, but that's ultimately, Big Brother K, up to you how you want to do that. But I would put that money to work in some way, shape, or form, you know, when you do your next rebalance. No matter what you put it in, pretty much, I think you'll be better off with it in some sort of reasonable investment based on your risk tolerance and risk capacity and all those sorts of things than simply leaving it in cash for the next 16 years. I think you'll look back 16 years from now and be glad that you put it into whatever you put it into that wasn't cash.
Yeah.
So, all right. Next, he has Roth IRA brokerage, $1,400. So my note there, I just wrote down, bump it up. And I said, like we talked about earlier, excuse me, look at income to see if the backdoor Roth IRA is needed. If it's not, full throttle, meaning that if you don't have to do the backdoor Roth IRA based on your wife not working at the moment, you bulking up your pre-tax contributions to your 401k plan, like going from Roth to pre-tax potentially. Maybe, I don't think you put this in here, but maybe you have other things like health savings account contributions, things that are going to bring down your adjusted gross income. If you don't need to do the backdoor Roth IRA method, then I would full throttle be considering looking to put that, like we talked about earlier, $7,000 for you and then $7,000 for your spouse into your own respective Roth IRAs for a total of $14,000, like Cube said. If you are, based on your situation, going to be over the modified adjusted gross income limits for 2024, then just be aware of the aggregation rules with that traditional IRA. And I think we've talked about this before on the show. I don't want to spend a ton of time on it today. I think we might have talked about it on the Don't Fuck Up the Backdoor Roth IRA show. I think that's literally the title of the show, Don't Fuck Up the Backdoor Roth IRA. So if you haven't caught that one, go back and listen to it. If you still have questions, email the show. But you do want to be aware of that if you do end up having to go the backdoor method. And ideally, we would like to see you at the point where, I mean, it's a good problem to have on the one hand, but on the other hand, if you could do something as simple as tweaking some Roth 401k contributions to pre-tax 401k contributions and lower your income enough to not have to fuck with it, probably the way you want to go. So that's what I'm thinking.
Yeah,
good there?
I would agree with that, yeah.
All right. Current 401k, $152,000, and then in parentheses, 14% of which is Roth. So again, it's great to have that tax diversification, but you want to just take a second look at that based on what we've talked about so far. Self-directed IRA, $25,800, and I just have cool in what? And I'm just curious, because most of the time when people are doing self-directed IRAs or even Roth IRAs or solo Ks, whatever people are doing these days, for self-directed has a different meaning to different people. So just for the benefit of the listeners, because I don't think we've done a separate show on this to this point, we may or may not, but self-directed to some people means I pick my own investments, kind of like a do-it-yourselfer. And some companies might call it that, but there are self-directed accounts that are different than that. So what he, I believe, is talking about, and what a lot of people are talking about when they talk about self-directed accounts, these are retirement accounts that can be set up in a multitude of different ways that typically are going to be held at a custodian where you as the individual investor client are making your own investment decisions, but you're investing in non-traditional, quote-unquote, types of assets. In other words, you got money in a retirement account that you can do whatever the fuck you want with, as long as the IRS says you can't do it, right? Things like life insurance and collectibles and shit, right? But as long as you're not doing those things, you can invest that retirement money in anything you want. If you want to invest in fucking cattle, if you want to buy a rental property, if you want to do private money lending, if you want to, whatever type of investment that's an allowable investment that you're not going to find at your typical brokerages and discount brokerage firms of the world, they have special providers out there that allow people to invest in these types of things, which I have mixed opinions about. I don't know if I've ever talked about this publicly on the show or not. I do have a self-directed Roth IRA that I use to make some agricultural real estate investments with. So far, I'm not overly pleased with that decision. That's a conversation for another day. It can be done. There's some additional considerations. There's some additional considerations. There's some additional red tape. There's a lot of things that go along with that. So it's not for people that don't know what they're doing. Big Brother K seems like he's pretty organized based on what he sent, pretty detail oriented. So I was just curious what that might be, and maybe he's doing some private money lending. Maybe he, it's down payment and he has some non-recourse debt on a real estate turnkey rental deal, something like that. Who knows? But that's cool that he has that going on. I have no clue what that's in. But again, we're not giving specific advice or any advice really. So. Almost doesn't matter, but I think that that's interesting. But again, just be aware of the aggregation rules because the values, it just says self-directed IRA. I'm going to assume it's a self-directed traditional IRA. The values in that account will count against you for the purposes of the calculation in terms of your conversion amount if you end up having to do a backdoor Roth IRA. So all that to say, cool, but be careful. And at the same time, just beware of the aggregation rules on the backdoor Roth if you have to use it.
I would just say, depending on what's going on there, maybe just roll that motherfucker into your other traditional IRA. And I'm trying to make your life easier, Big Brother K.
Yeah.
You got a lot going on. You've done well, but I mean, personally, I wouldn't want to keep up with all the shit. So it's like, there's things that you can do to maybe make your investing life a little bit easier. It might give you more time to focus once we get down to the real estate part of it.
Yeah, and that's valid. The other thing is, and again, this is not advice, but something to think about. And again, I don't know based on what you sent us, but I'm going to try to read between the lines. The traditional IRA, where you said you had roughly 22% of it in cash, I'm going to make the assumption that that is a brokerage type of IRA. Did he say that in here? I don't think he did. No, it just says traditional. I'm going to assume that it's a brokerage type of IRA where you're doing your typical standard marketable securities, right? Stocks, bonds, mutual funds, ETFs, shit like that, okay? And that the self-directed account is, again, some of these non-traditional investments. Now, what I would say here, to Cube's point, is maybe you do nothing, right? Who knows? But maybe it would make sense to consolidate these two accounts into one of them, depending on where you're more comfortable. Now, again, I'm guilty of this, right? I have a Roth IRA that is a brokerage Roth IRA, right? I have to do the back door every year, have for, I don't know, many years now. And that's invested in the markets, the public markets. But I also have a self-directed Roth IRA that, like I said a minute ago, I wish I didn't have, that's invested in agricultural real estate. So that's a little bit complicated. But let's say, right, you're doing private money lending for real estate, right? Maybe there's a house flipper that you know that's in your real estate investor network, right? Because we'll get into this here soon. He has some real estate of his own. So maybe he's networking with other real estate investors and he lent somebody some money through his IRA. And maybe they're, I don't know, I'm making this up. Maybe they're paying him 10, 12% interest on that essentially kind of quote unquote hard money type of loan, right? Okay, great. Are you doing that in your stock market account? I don't know. Some years, yes. Other years, no. But on average, probably not. If you're doing better or more comfortable in one area or the other, maybe you consider transferring IRA number 1 to IRA number 2 and then being able to have a larger pool of capital to do that private money lending with because you can generate a higher return by doing that. Maybe that makes sense. Or maybe you have it in something, you did a non-traditional investment deal and it was like, yeah, this was okay, but this is a pain in the ass and I'm paying all these fees to have this fucking account every year. Like I know the provider I use, and it's changed hands at least once since I've had it. I pay, I'm embarrassed to say this, but I pay I think it's like $100 a quarter, so $400 a year just to have that account sit on a fairly nominal amount of money. It's not that much money, really. So maybe you're in a situation where you're in an investment that is liquid enough to get out of it, and if you're tired of fucking with it, quite frankly, I wish I could do this with mine and just take it and transfer it back into my other account, you know? So something to consider. Maybe you like the diversification and you like to have money in multiple places, that's fine. But maybe you're trying to clean things up and simplify, right? You're married now and you know, you're going to have, your wife's going to have some other accounts. I know you said in your email she doesn't have significant retirement assets, but maybe that changes. Maybe she does want to start getting into investments and maybe all of a sudden you start to accumulate more accounts and more things. Something you might consider doing is maybe cleaning up some of your accounts in terms of the number of accounts that you have. Only do that if it makes sense from an investment standpoint. Don't take one and transfer it into the other just for the sake of eliminating one account. But as you're thinking through these things, maybe that's something to take into consideration is what is my investment strategy? Do I need this diversification, or does it make sense to consolidate these two accounts into one and go with one particular style of investment? Okay. You still there?
Yeah, I'm here.
Yeah. I thought I put you to sleep. Okay.
No, I agree. It's just, yeah, I think that he can make it a lot simpler.
Yeah, I mean, and quite frankly, again, I don't know what the provider is that you're with that's doing the self-directed investments, but like most of them charge fairly high fees relative to like just having a you know, marketable securities type of account. So you really have to ask yourself, you know, is it worth it? And if it is, maybe it's not an all or nothing. Maybe you like the diversification. Okay, maybe you transfer or do a partial transfer from the other IRA into this one to have more money to play with, and then the fees on a percentage basis at least are more reasonable, you know? Like if you're paying, I don't know what you're paying, but let's say you're paying $400 a year in fees for this self-directed account and you only have $25,800 in there, you're paying 1.55%, you know? To some people that's not a lot, to other people it's like, holy shit, that's expensive. You know, and there could be additional fees that are charged. So just, you know, just take a look at that. That's all we're saying.
Maybe he's got some Bitcoin in there.
No comment. Let's see. All right. And then he provides a benefit estimates table for us, and he has different ages for Social. I'm going to assume these are Social Security retirement benefits based on the information that he has in there. And I think, yeah, he made a comment in here. I anticipate collecting Social Security between the ages of 62 to 65, but 65 at the oldest. Okay. I don't know your situation. I don't know your beliefs around Social Security retirement benefits. I don't know your health or your family history or, you know, longevity or anything like that. But I would say you may want to reconsider that, especially if you're going to be consulting during that time. You're going to be subject to the earnings test anyway prior to full retirement age. So that's something to consider. The other thing, and again, I don't know what your wife was earning when she was working and what she might be earning in the future if she were to go back to work. But generally speaking, the primary earner should consider delaying. And there's several reasons for that. But one thing a lot of people don't realize is that the higher household benefit will remain, essentially. So if you have somebody that's getting a higher Social Security retirement benefit and then somebody passes away, the survivorship benefit is generally going to be that higher amount as well. So just something to keep in mind. At 65 here, he has a little over $2,600 a month, $2,661 a month. If he takes it early at 62, and technically he would be taking it early at 65 as well, but he would get even a larger reduction at 62. He would only receive $2,062 a month. If he waited until his full retirement age, which based on his year of birth is age 67, his benefit jumps up to $3,162 per month. And if he delayed all the way out until age 70, you're looking at $4,051 a month. And normally, when we work with clients, we would actually run information through our special calculator, which talks about collection strategies. And normally we're trying to maximize the cumulative lifetime retirement benefit that a couple would receive. And that's all beyond the scope of today's podcast, which again is for, entertainment and information only. But I would strongly reconsider potentially taking it a little bit later. If you're dead set on it, that's fine. You can do whatever you like. But generally speaking, people that take it early are either one, afraid, quote unquote, it's going to run out, which we can do a whole show on that. 2, it's for health considerations or reasons. Or 3, and I don't think this is you, they have a need, they need it to live, right? They have to have that income now to make ends meet now because maybe for whatever reason they cannot work any longer now. I don't think that's you. So just think about that, and you may want to consider taking it later. Cube?
Yeah, I mean, the only thing that really matters is how long he does the consulting for. I mean, if he ends up deciding he don't want to do it and he decides to take his Social Security, fuck it. I mean, I think at that point he'll be fine either way. I think the whole delay thing is any financial advisor that you talk to is probably going to tell you it's a delay because that's what they do. Yeah, that's what the numbers show in a perfect world, but it's, I don't know. I mean, Social Security is more than just, obviously you want to maximize, but I thoroughly understand the idea of taking it as soon as you can get it, and guess what? If you don't need it, then fucking invest it.
Here we fucking go. We got one of those in the crowd tonight. Yep.
No, I'm just saying that, I'm not against taking it early. I'm not against taking it later. Obviously, if you still have some income coming in, then there's no point in taking it, more than likely. Once your income ceases to exist, then, fuck it. Get your money and go on some fucking trips.
One other thing to think about, and I think a lot of people, they don't think about this when it comes to retirement income planning, is when somebody retires, a lot of people are under the assumption that they have to retire and then they have to take Social Security retirement benefits right away, and that's not true. And his example is actually a decent one. Again, I'm not fully digging into the numbers. This is kind of all off the cuff, but you go back and take a look at that traditional IRA, for example, right? He has $291,000. And then what do we say? He has, let's do some quick math here. 291, and then he has 25.8 in the self-directed. It's 300 and change, right? He's 46 years old, right? So when he's 56, let's just say we double, and then by the time he's 66, we double again. Let's say, and I'm making a big assumption here, but let's say that and by the way, for those that are wondering, what I just did in terms of the doubling is just a general rule of 72, right? Which basically tells you how long it takes your money typically to double. So, if you took a 10-year period, we assume he gets 7.2% average annual rate of return over that time period, then he's going to double his money every 10 years. So all I did was take the value at his age now, double it 10 years from now, and then take that value and double it again 10 years from then. Is it going to work exactly like that? Probably not. But just back of the napkin, quick math, that's what it's telling you. So if he doesn't do anything else, and we assume that there are no additional dollars in this, which we already know that he has other pre-tax dollars because of what he told us about his 401k plan, his traditional 401k plan. But we're looking at 1.267, so call it close to $1.3 million that's going to be sitting in pre-tax assets. So let's say he retires from his full-time job as he initially is planning on at age 62. Let's say he does the consulting thing from age 62 to 65, okay? Now, and this is probably beginning a little bit beyond the scope of today's show, but for those that are following this, I think you'll enjoy this thought process. Now he's 65. He's no longer, let's say he's no longer working. He's fully retired from work. He is no longer consulting. So earned income, we'll assume, stops for him. based on the way the rules are now, because he is born after the year 1960, his required minimum distribution age, the age at which he must begin to withdraw from his pre-tax accounts, is going to begin at age 75. So he has a 10-year window. Now, there's no economic benefit to delaying Social Security retirement benefits past age 70. So that scales us back 5 years. So now we're looking at a 5-year window from age 65 to 70. What a great fucking time to consider delaying collecting Social Security retirement benefits and consider strategically doing some partial Roth conversions over a period of 5 years so that he can take some of that pre-tax money in the traditional IRA and move it into the tax-free zone into his Roth IRA, and therefore not be subjected to minimum distributions any longer on those funds that now reside in the Roth IRA, and go from there. Will he be able to convert it all over 5 years? I don't know. Probably not. It's like $250,000 a year. That may or may not be in the cards for him. But even if he did a portion of that, I would argue that he may be better off by doing that. And as we'll talk about here shortly, he has other assets and potentially other income sources that will be coming in during that time frame as well that might allow him to do this. So there is some real benefit and power to retiring and then using some years between retirement and Social Security collection age to do these partial Roth conversions, and therefore he doesn't have required minimum distributions on this $1.3 million account, which is likely a lot more than that when you factor in the pre-tax money sitting in the 401k, right? Because what's going to happen there is once that kicks on, then he's potentially going to be permanently in a higher bracket because of those RMDs, and he can never fucking get out. But if he takes the 5 years to shave some off and dump it in the Roth, well, that's less money that's less of an account value in the pre-tax portion, which is less money that he has to worry about the RMDs being calculated on, which means it's less he has to take out in the form of RMDs, which means that ostensibly he is less tax that he has to pay on those distributions. Does that make sense?
Yeah, it does. And that is an option. Or, yeah, I mean...
That should be a fucking TikTok clip. I don't do TikTok, but we should just have that run down on there, like boom, 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 mic drop.
Yeah, I mean, he can do that. I mean, when you have assets like he has, I mean, you have options basically of how you want to go about it.
Yeah, I mean, the guy's in great shape. Overall, I did some quick numbers on it when I was putting this thing together. He's worth between 1.5 and 1.6, right? And that's not including anything from the wife, and that's him at age 46. So, he's a millionaire. Great job. I mean, that's awesome, So he's no matter what, you're going to have options. But I'm just saying, if you're open to it, then that's good. If you're not, consider or reconsider becoming open to it, because there's some interesting planning-related things you can do from a retirement income planning standpoint and asset location standpoint that will make more sense if you're open to the idea of potentially delaying Social Security, is what I'm saying. All right. So there's that. Any other thoughts on Social Security besides, fuck it and take it now and invest it?
No, Social Security's pretty boring.
Yeah. All right, cool. Next is insurance. So he said that he has $750,000 of group life through his employer. He has $160,000, and I'm gonna get on his ass for this one, for ROP term expiring in 10 years, which stands for return of premium, and then $50,000 for group life insurance through the credit union. So if I do the quick math on that, our total is at $960,000 of insurance. So my note that I wrote down here is $960,000, of which only $160,000 is individual coverage. So a couple bullet points, Big Brother K, for you to think about here. Number one, I would find out about the convertibility of your employer group life insurance. If you get let go or you leave and retire or whatever the case might be from that employer, and assuming you still have a life insurance need at that time, what are your options? Can you convert it to an individual policy, and can it still be term coverage? Do you have to convert it, but it can only be converted into a permanent policy? And what does that look like? So those are some things to think about. Number one, find out about the convertibility of that employer group life insurance. Number two, I would consider personally, based on what you said about, at least at the moment anyway, your wife not working and not having an income stream, and then you have believe you said you had a stepchild, age 12. So, they presumably are relying on you here for your income stream. So I would consider, doing a needs analysis for your life insurance amounts and consider getting a larger individual policy, especially if you find out that you have shitty options in terms of convertibility for your employer-sponsored group life insurance of the 750. And then second to last here, $50,000 of group life through the credit union. Okay, that's fine, but depending on what your plans are, and again, it's going to be different for everybody, maybe that covers final expenses, maybe that covers, I don't know what a fucking casket costs these days, right? Depending on what you're trying to do. I was talking to my wife the other day, and we were talking, I said, we really need to iron this out, because I don't know if we ever got to the bottom of it, but I was thinking about like just having some money set aside and putting something in our docs that basically say like, hey, just go ahead and throw a party, like a end of life celebration for me. You know what I mean? Like, hey, Cashflow King had a great run. Like, let's all wear fucking rainbow colors, not rainbow colors, but like fluorescent colors and shit, and have a good time. We'll fly Cube in from fucking Vegas, and we'll have a good time with it. I don't know. But anyway, depending on what your plans are, $50,000, maybe it gets it done, maybe it doesn't, but I don't think it provides the income continuation that you might be seeking. So start with the group life, figure that out, see if you need any more individual life. And then also, I would rethink the ROP, the return of premium, because there's an additional cost for that, as you know, and there's a time value of money component that goes along with that. So for the listener that may not be familiar, if you're going to buy insurance, right, let's say you're buying some individual term life insurance, you can go and get quoted, based on your underwriting class and all that shit, like here's what the premium is. All right, cool. Now, here's the cost of insurance, and you're going to pay X number of dollars per month or per year or whatever. Okay, fine. Or we can dangle this carrot in front of you and say, hey, if you pay a little bit more and you don't die, we'll give you your money back at the end of the time period, at the end of 10 years or 15 years or 20 years or whatever. That's return to premium. And if you do the math on that, I would say that you are unnecessarily paying more in premium now just to get essentially discounted dollars back later. And I am personally not a fan of return of premium. You?
Yeah, I mean, I agree with what you said there, and I'm not a huge life insurance person, but this is one case where, I mean, yeah, just scrolling down as we get further down through here, we're looking, I mean, he basically has enough life insurance right now to cover all of the mortgage debt that he has and not much else. So,
yeah,
I'm a fan of cheap term policies, maybe at this stage even, depending on health. But, I mean, I could realistically see that he's 46. I don't think it says how old his wife is, but, maybe even just a 10-year term policy. That would get him to 56. That would,
yeah,
him,
and
more of the mortgages will probably be paid off by then. It's not like he has to do anything fancy at all. It's like, you can figure out what you need, based on what your expenses are, and if your wife ends up, finding employment and things like that. But I mean, just a number that popped in my head, and it's kind of random, that just came up, was probably like at least $2 million on a term policy is something that would make sense in addition to what you have through work. And it looks like, you're probably going to still be working for those 10 years, so you'll have that work policy. Isn't that what he said? Yeah, target retirement year is 2040. So, maybe even go all the way through your retirement at that point, maybe a 15-year term. So, yeah, it just all depends on cost versus years.
Yeah, I haven't
agree that he needs a little bit more there.
Yeah, I haven't run the numbers to do the full analysis for him, right? But like, just that's something to definitely look at and be thinking about. And, what would you want to have happen? We'll get into your real estate stuff here shortly, but I'd be thinking about that. And no matter what, we're not saying that like necessarily get rid of, your 10-year term policy that's return a premium. You already have it in place. Chances are when you bought it, right, most of us, we were all younger when we bought it, right? And maybe we were healthier then, maybe not, but probably so. And so maybe you keep that in place, but you simply add on, like Cube is saying, whatever you feel you might need as an additional, insurance, but opt to not go with the return of premium at that point. At least personally, I wouldn't do it. I don't think it makes sense. But again, everyone's different as far as that goes. So yeah, maybe consider some more insurance there. The next thing you have on here is emergency fund. Okay, so this is different than when he talked about the primary account. So the primary account, going back to the beginning of the episode, we had like $8,500, right? We had the CDs going on, the 211, 2,000, 1,000, 1,000, and then we had like $4,500 in the checking. So that's the primary account. Now his emergency fund is basically $30,000, and he has this broken out here. He has $6,000 of it in cash, and then he has $24,000 of it in basically a Vanguard dividend fund, right? He puts a ticker symbol in here. So that's interesting. We kind of alluded to this, I think, on the last episode with Cashflow Rockefeller Prince about, depending on how people view their emergency funds differently. Some people will have a portion in cash and then another portion in some sort of like taxable brokerage account, and then, look at it collectively. So it's very clear to me that, and I think this is a good thing, that Big Brother K is very cognizant of keeping the money working and trying to sort of maximize his yield. And maybe he's picking up additional yield and potential upside by having it in this dividend fund, and that's why he has a smaller portion of it in cash. He then goes on to talk about another online banking account, so I would assume he already has some type of high-yield account. This one is a $4,000 CD that's 10 months, and it looks like it matures at the beginning of 2025. So, Cube, what are your thoughts on his emergency fund and online banking situation?
Yeah, like you said, I think that having it invested is okay. Honestly, I would take that $4,000 when it matures on the January of next year. I would put that in with my other bank account. What I think you called it, the primary bank account. I would move that in there. I will say, and I don't know why he has it separate from his emergency fund. I don't know if that $6,000 cash is in the brokerage account where he holds the rest of that emergency fund or what. If not, I would put that $6,000 in the primary account with the other cash. I don't know. Maybe there's a reason why he does this. Maybe he knows that if it's sitting in his primary account, he's primed and ready to spend it. I'm not exactly sure, but I think that that would just make his life easier, and then just have the rest of that emergency fund sitting there in the mutual fund that he has it in.
Yeah.
If he's comfortable with that. So, it's just a matter of consolidating. I mean, a $4,000 10-month CD, quite frankly, Big Brother K, it's doing nothing for you, brother. You make enough money, you've done well for yourself. I wouldn't want to deal with it. I wouldn't want to keep up with it, try to figure out where it is, try to figure out what to do with it when it comes due. Just throw it in that primary bank account, and like we referred to before, you can find some bank accounts that aren't with big banks that can give you a little bit more yield if that's what you're looking for.
And he doesn't even need to necessarily put it in the primary account. Like you said, this emergency fund, even if it is a brokerage account, he could probably just take that $4,000 when it matures, put it in the brokerage account, put it in some sort of, risk-free rate, essentially, probably getting something comparable to what he was getting in the CD anyway, and just knock out that account that he has with the online bank,
Right, yeah.
Because it seems to me like the personal account is, if I'm reading this right, his emergency fund is $30,000, right? And he doesn't say this, but I'm going to assume he has a 6-month emergency fund. He's spending maybe $5,000 a month, something like that, right? So if that's the case, because he keeps $4,500 in his checking and then a few laddered CDs, I don't know. Yeah, but that money, that can be consolidated wherever you want somewhere. But yeah, the 10-month CD is probably, I get it, because this is like me in a way, but at the same time, you got to clean it up at some point. If you told us, hey, it was $400,000 and it's getting, some crazy percentage, interest rate versus this other account that if you dumped it in there, it's going to earn nothing. Okay, fine. But every little bit adds up. We get that. But do yourself a favor and start to clean it up. Because I noticed, and we'll get into this as we go through your real estate stuff, and this is something near and dear to my heart too, but it seems like you have some things partitioned and segregated for the different real estate properties that you have, which is other things. And I get it. And there's reason to do that. I'm totally on board with you. But if you can simplify your personal life in the process, I think that would do you some favors. So I think Cube and I agree that that $4,000 CD, when it comes up in January, move it somewhere on your personal side of things and maybe get rid of that account and clean it up. All right. Let's see. Primary home. Current value $320,000, seems reasonable. Original mortgage was $267,000. Current mortgage balance $254,500. Maturity date 2052. Interest rate 3.125%. Payment $1,720. And all I did was underline your interest rate and wrote love it. I think it's a great rate. I don't think there's any reason to be in a rush to pay that off or pay that down early. Again, there's the psychological component, but the math says don't do it. And I think that is reasonable. It doesn't seem to me like based on your income, you bought too much house like a lot of people tend to do. I think that's a perfectly reasonable setup there on the personal side.
Yeah, I would agree with that. There's really nothing to do with it. Just keep paying it.
Okay, all right. Next, we get into real estate. So investment property. Yeah, we have a couple of investment properties, then we get into some debt, and then he has a few questions at the end. So investment property number one, he has what appears to be a triplex. It says 3 units here. He gives us the rents, which are $790, $850, and $975. So I added those up, total of $2,615 a month. He says that the current value on this property is $320,000 with an outstanding mortgage of $148,000. And then I was a little confused by this. It says second mortgage / HELOC for $90,000. Below that, maturity date, October of 2036. Interest rate, 2.375. Fuck yeah, that's pretty good. And then before we get into his other, banking stuff on this property, we'll kind of cover the top part first. So I had some notes here where it says second mortgage / HELOC. Okay, well, is it a fixed second? Like, is it a mortgage loan? Is it a HELOC that is variable? Did you get a HELOC that has a fixed lock-in feature? Like, I'm a little confused as to what that looks like there. I'm going to assume that the maturity date and interest rate are tied to the outstanding mortgage of $148,000, and that the second mortgage / HELOC is a variable rate, which obviously can vary, because when you get into your debt, you don't mention HELOC anywhere else in the document, and you have a $650 a month payment for the HELOC. So I'm going to assume that that's for investment property number one. And, some quick math on this. Let's see here. Before I get into the banking stuff, current monthly payment on this investment property number one, this triplex, $1,972. And then you made a comment that the top floor will need total renovation when the tenant moves out. So I did some quick math on this, just based on the numbers that you stated. If you look at the outstanding mortgage of $148,000 plus the HELOC of $90,000, and you compare that to the current value of $320,000, you're at about a 74% loan to value. So I think you're using, like, the debt itself on a percentage basis seems reasonable to me. You got about $82,000 of equity, also seems reasonable to me. But when you look at your rents, if I'm looking at that, the $2,615, right? And I'm going to do this again because I did this. I just want to make sure that I was doing this correctly when I was thinking of, and writing all this down. $2,615, if we back out your monthly payment, which I'm going to assume is principal, interest, taxes, and insurance of $1,972, we're left with $643 a month. And if your HELOC payment of $650 a month is in fact on that investment property number one, before property management, before repairs and maintenance, before vacancy, before lease up, before CapEx, before anything, you're losing $7 a month on this property. So I was scratching my head a little bit on this one, Big Brother K, honestly. Like, I'm not really sure what's going on here. You're making basically, from a cash flow standpoint, I understand there's more components to total return, and maybe that's part of your strategy. So if so, that's, we can talk about it. But you're making $214 a unit before property management. And I don't know if you're self-managing or not. I'm going to assume that you are. But even if there's a day where you didn't want to anymore, it's usually generally advisable, and again, this isn't advice, but it would be advisable to factor that cost in with your other expenses with the assumption that someday at some point you likely would, or might want to have it managed by somebody else. But you're making $214 before a PM, before any expenses, before a lot of things. And again, that's before the $650 a month HELOC payment, right? That's $214 times 3, but then you subtract $650, that's $643 minus $650, you're $7 in the hole on this thing. So even though the 2.375 sounds cool, like, what else is going on here? And then, real quick, and then I'm going to turn it over to Cube. Under the bank account section for this property, you have $2,000 2-month CD, then you have another $2,000 2-month CD, and then $4,000 checking. So basically, we have $8,000 of cash, which realistically is only 4 months of PITI, principal, interest, taxes, and insurance. But what I didn't factor in when I made that note was the HELOC payment, right? So if we take the 1972 mortgage payment plus the 650 HELOC payment is 2622. If I take that 8,000 divided by 2622, we have just north of 3 months there. And you made a comment on this property that the top floor will need total renovation when the tenant moves out. And my question there is, how are you going to pay for this? So honestly, at first glance, investment property number one, unless there's other information that I don't know that you didn't send in, or I'm just completely misinterpreting this, I'm having a tough time with this one, and quite frankly, I don't know that I like this one. What do you think?
Obviously, you're more of a real estate guy than I, but your numbers all make sense. But just looking at it, it doesn't really. I don't know. I'd like to know what he purchased it for, because that payment, does that seem right to you?
Honestly, I just took it at face value. I didn't rerun any of these numbers like that. I was just okay.
If the current value is $320, hell, if you even say he bought it at $320,
0.82 rent to value. That's what I calculated.
With a 2.375% interest rate, your monthly payment would be lower than that, right?
I don't know. I haven't.
I'm trying to do math in my
Unless he has the 650 from the HELOC factored into that, right?
That's the only thing that would make sense to me.
If that's the case, I feel a little bit better about this one.
That's what I'm thinking. That was my initial instinct, was something else has to be, because there's no way. I don't know. The math doesn't. I'm not running the actual numbers, but just glancing at it, I don't think you'd have a $2,000 monthly payment if you bought something for $320, assuming he paid what it's worth now.
Well, the other thing is, I don't know when this property was purchased. I see the loan maturity date of 2036, which is 12 years from now. So, like, is this a variable rate that has a balloon and your plan is to refi it or sell it by then? Like, there's so many variables and things that we don't know. And I know Big Brother K, I probably did say in his email, like, hey, if you have, any additional questions, ask me. He actually offered to come on the show if we wanted to make it interactive, which is fine, and we appreciate that. I like the interactive part with Cube because, again, the goal of this is to give people things to think about, but it's not necessarily to have people come on here for us to give him individual one-on-one advice. So if we can talk through this and help Big Brother K think about some things and think through some things, but at the same time we can talk through this and the listeners can hear our dialogue and our thought process, and it helps them with their own situation somehow, that's really what we're going for here. So that's why I didn't reach out to him to come on.
The only other thing that I could think of would be if it's a 15-year mortgage, right?
It could be.
That would be possible, and why the monthly payment would look so weird numbers wise. I just I would assume it's not a 30-year unless he bought it, 20 years ago, which I guess he could have.
I'm going to assume it's either short-term rate or a variable rate that has a fixed component that ultimately will reset on him at some point.
Right, and that's what I'm thinking, because if he did like a 15-year variable that started in 2021, let's see, when does his other property? Gosh, his other property has hold on, that's the portfolio. Anyway, I agree with all your numbers. I guess there's more that's needed to know on this. Like I said, that interest rate, it seems insanely low, but also I guess there's probably no way it's on a 30-year. So I don't know. Maybe if he considered, doing some type of cash out refi to get it all onto one mortgage and do a 30-year fixed. I don't know.
I don't know that I'd be
You're
doing
more
that
of a-
now. Yeah. I wouldn't be doing that now.
You're more the real estate expert than I. I mean, I don't think now's the time to do it, but if he's going to have to change that rate at some point, then maybe something to be in the back of his mind to think about.
Yeah.
Over the next 10 years.
Yeah, if this was me, I'm thinking about, okay, what's going on with this HELOC? What is the plan to get rid of that thing? Which actually I'll get to something that I was thinking about on the next one. But what does that look like? Is it locked in? Is it a variable rate? Is there a lock-in feature? If there is a lock-in feature, have we thought about that at all? What's going on with it? No matter what, the $8,000 in cash is just not enough. The $8,000, my guess is it probably will not even be enough to do the total renovation when the tenant moves out on the top floor. I don't know where the property is. I don't know what the condition of it is, but you literally said we'll need total renovation. To me, total renovation is more than $8,000, but who knows? Maybe you're handy, maybe you're somebody in construction or something like that, and you can get a good deal on some pricing. I don't know, but even if your buddy's doing it for you, and they're giving you a deal, excuse me, I still don't know that $8,000 gets it done. That's number one, because that's all you have. Number two, even if you didn't have the total renovation coming up, and even if the HELOC payment is included in the 1972, let's just call it $2,000 a month. If you're paying $2,000 a month on this thing for mortgage plus HELOC payment, let's just say that's the case, and you have a total of $8,000 in cash, we're talking about 4 months. And from a, defense positioning and just, playing defense and just trying to be conservative here with cash on an asset like this that has at least 2 different types of debt tied to it, I just don't think we have enough going on there. So I would seriously work on and consider, where you need to be from a cash reserve standpoint, but I don't think $8,000 is the number. I think it needs to be a lot higher than that. So that's my opinion on that one.
Yeah,
so
I would agree with that.
So if the HELOC payment is in addition to the current monthly payment in 1972, I think from a cash flow standpoint, it's a dog, and I would really take a hard look at it. If the $650 HELOC payment is included in the 1972, okay, fine. Maybe it's better than we thought. I don't know if your rents are near market or they need to be pushed up, or when the top floor moves out and you do a total renovation, I don't know. Is the top floor renting for $790 and all of a sudden it's going to be renting for $1,100? I have no idea, right? So depending on what that looks like, that could factor into it. But I would really want to get a strategy together for what is the plan for this 2036 maturity? What is the plan for the HELOC? What is the plan to get the cash up? And are my numbers correct? And if I rerun those with professional property management, assuming that I don't want to be managing this thing when I'm 65 years old, is that factored in? And if not, what does it look like once we do factor that in, and then proceed accordingly? So lots to think about on that one. Investment property number 2 looks like this is a quad or a fourplex. We have 4 units here listed: 850, 850, 850, and 675 for a total of $3,225 a month. One thing I noticed on this is the 675 was kind of an outlier. I was just kind of curious. Maybe that's a long-term tenant that's under market or something. I was wondering why that seems so much lower. The other ones seemed a little bit all over the place. Maybe there's some units bigger than others, but with a fourplex, generally speaking, a lot of times you'll see those units of equivalent size. So I was kind of curious as to why that one unit was only renting for $675. He says it's worth $400,000 currently. Outstanding mortgage is $267,000. 5-year portfolio loan with a maturity date of June of 2028, so basically just under 4 years. Interest rate 7.25%. Checking balance is $2,000. Current monthly payment $2,468. So we do not even have 1 month here of principal, interest, taxes, and insurance. I don't like that. I don't like the portfolio loan that is going to be due here in just a few years. The interest rate, well, it is what it is, in the times that we're in. I mean, what are you going to do? 7.25%, 7.25%. Don't love it, but I get it. 68% loan to value is what I calculated on this one, with $133,000 of equity. And, your gross per unit before, assuming we don't have property management factored in or any other expenses, is about $190 a unit, which again, I think is pretty lean. Honestly, I don't love it. You got some equity trapped in this thing. You got a balloon that's coming up. You got less than 1 month PITI in checking. I don't know what kind of shape the units are in. I don't know what your long-term plan is, but one thing that I was thinking, and I don't know what you want to do, and this isn't advice, this is just kind of off the cuff, back of the napkin type shit, but what if with that $133,000 of equity, what if you did sell this thing? And then after your closing costs and seller, fees and everything else, you walked away with $100,000, right? Or even $90,000. And that were going to kill the HELOC on investment property number one, right? Assuming that that's at a variable rate. So now all we have is a $148,000 mortgage on investment property one with an interest rate of 2.375. And now we have a little bit more cash to work with. And we, I don't know. That's just something. I'm not trying to collapse your real estate portfolio here, Big Brother K, but I'm just looking at this like, if something goes wrong, what happens? And maybe you say, you know what? If something goes wrong, I have my own personal accounts, an emergency fund, and CD ladder, and okay, fine. But do you really want to have to personally be feeding these? I know, obviously, if you have to, you will because you don't want to lose them. But I don't know. I'm not overly thrilled with either one of these two properties so far. Cube?
I would agree with the part that, they both seem a little bit light as far as the cash balance that they have for each of them. I'm just trying to think, worst case scenario, the shit hits the fan. That's they're not in great shape as far as that emergency fund for each property. Like you said, there's so many variables to rentals that, I would think that Big Brother K would know, if he can increase some rents, to make the numbers work out a little bit better, and, what the status is of the properties and things like that. All of what you said about the numbers makes sense to me, but, at the same time, I guess he's got to kind of do whatever he's comfortable with and what he knows. Like you said, he may be able to instantly get $175 a month once he bumps that one to $850 with it, and then can we get all the $850s up to $900 type of deal? I know rent's been fucking going up outrageously lately, so there's a lot of variables that go into real estate, and ultimately, like you said, it's kind of up to him. It doesn't look like they're putting off any form of great cash flow to me. And then, also they're pretty large figures of debt for him to carry on his balance sheet.
Yeah. Yeah, if you look at the cash position of both of these investment properties, you got $8,000 on one. Am I doing that right? Yeah, it's actually... For some reason, I put 11. It's not 11. You got 8,000 on one and 2,000 on the other is 10,000, and we have 3 plus 4 is 7 units. So our basic, if you want to look at it on a per unit basis, our baseline reserve number per unit here is $1,428 and change. So, I personally would feel way more comfortable having a larger reserve per unit, however you want to look at it, per property. I just think that, and then Cube and I are in agreement on the cash thing, that it's a little bit light. I don't know if you're trying to continue to grow or expand your portfolio or not, but quite frankly, overall, you have a really nice balance sheet. Again, if... Oh, and by the way, I misspoke earlier. I said he was worth between 1.5 and 1.6 million, but I'm looking back at my notes. That was total asset value. It's between 1.5 and 1.6 million. If we net those out, his net worth is actually closer to around 800,000, a little less than 800,000. So you are knocking on the door of millionaire status from a net worth standpoint. And I don't know what your level of interest is on things like, syndications or things like that. That's actually one of your questions or one of your statements on the next page. You mentioned that you would like to do a syndication in the near future. Quite frankly, I don't see it happening given I'm going to call investment property one and investment property two the business side of things, right? I don't see you being able to invest in a syndication on that side of things, given the numbers that you've provided here today. I think we need to beef those up a lot more to protect yourself in the event that something goes wrong and you need cash, because going to the next section, which kind of sort of ties together here, you go into debt. You mentioned an $8,000 student loan. I don't know what the interest rate is. I don't know what your plan is for that, but it's a fairly small amount, so I'm just going to leave that alone. But then you also mentioned $14,000 revolving / credit card. And so I'm wondering, are you paying that off in full each month, or are you carrying it with interest? I can't imagine that you're carrying it with interest, especially given all the little CDs that you got going on. But if you are carrying a balance at high interest rates, your 2-month or 1-month CDs, and I'm not trying to be an asshole here, but like those, the interest you're earning on those is going to pale in comparison to this revolving credit card, unless you're paying it off in full and you just happen to have a higher balance right now, or maybe you have a 0% card or something like that. I don't have all the information, right? But that is something that's a little bit concerning to me, that we see 5 figures on a credit card, we see lean cash positions on the investment properties, and yet we're wanting to still make additional investments. And trust me, I get it. One of the things that, I don't know if I talked about this in another show or not, but I think I did actually on the Lifetime Financial Flexibility podcast. Sometimes we as investors, and I'm guilty of this myself, we like to stretch a little bit. We want to grow. We want more income, more assets, more this, more that. But we always have to be cognizant of and be careful of still playing defense at the same time, because you don't want to lose it all or lose a property or whatever because shit hits the fan, it doesn't go right because we were so busy on playing offense, we weren't playing any defense. And so that's partially me talking to myself here too, because I'm guilty of it myself. And sometimes, we put ourselves in a certain position and then all of a sudden, we might end up in a bad situation. We don't want to do that. So I think that no matter what you decide to do with investment properties 1 and 2, I would really take a hard look at the numbers, take a hard look at your cash positions and reserves, take a hard look at the debt, and really come up with a plan in terms of what you are going to do with these properties. Think of yourself as, and you are, the owner, but you're also the asset manager here, and you need to figure out, okay, what's the best way to have this structured and have my assets and liabilities deployed here, and move the chess pieces however you want to so that it makes sense for your situation, but don't overextend yourself. And, again, I'm not trying to poo-poo on your numbers here, but I'm kind of sort of getting the sense that based on what we'll get into on the next page here with some of your statements and questions, that you might be on the verge of doing that. And we don't want to see you do that, right? We want you to approach, all of us approach or try to approach everything from a position of financial strength. And so with that said, I would just take a hard look at those two. And I think we kind of beat these to death here, but it's important. And, from weak spots or blind spots, like, yeah, okay, he needs more life insurance, but he has some life insurance. Yeah, okay, his emergency, but he has an emergency fund. Okay, but he has that covered. Well, now we look at these and we're like, holy fuck, where's the cash? So, all right. Anything else before I get on to his statements and questions?
Yeah, I would just agree. Whenever I got down there to the bottom with the credit card debt, if it is something that you're not paying off in full, I would get that shit transferred to a 0% APR card for however many months and make sure that you can get that paid off in that number of months.
Yeah, and there's there's some decent ones out there, like 15-month, 18-month. Sometimes you can even find a 24-month that I've heard about. But yeah, that's a tough one. But yeah, hopefully you're not carrying $14,000 at like 20-something%, bro. Because if you are, like, fuck the CDs, cash them in, and pay that shit off. Not advice, but seriously, Yeah. All right. So let's see. A couple things here, closing this out. Number 1, no car loan, but plan to purchase a car within the next 18 months. And my little note there was how. How are you going to do that? What kind of vehicle are you going to get? What's the price point you're looking at? What is that going to do to your debt to income ratio? If you're going to get a loan for it, what is that going to look like? What's your wife's income situation going to be at that time? Are you planning on, or if you're planning on doing additional real estate related investments and you're planning on, and hopefully you're not at this point, but if you were, something to think about, if you're planning on taking on debt to do that, maybe you're going to buy another property and you're going to have to get a loan or a mortgage on that property. Well, you want to be thinking about things like, how does having a car loan and a car payment affect your debt to income ratio, right? I don't know how you own these other properties, if they're in entities or if you own them individually, or whatever that looks like, but just something to keep in mind. And this is true for everybody. You want to, anytime you're going to do anything, but just thinking ahead, sometimes you don't realize, okay, well, if I had a car loan and I had a payment, like, what does that do to my DTI, my debt to income? And that could affect your capacity to take on more debt in the eyes of a lender because now you're a bigger risk because you have more monthly obligations. Anything on the car?
I mean, yeah, I would agree. Yeah, especially if that credit card debt is something that he's not paying off, I would probably push that as far as I could. As far as the car, obviously, I don't know the condition of his current car, but I guess a car loan can be almost anything. It can be $100,000, it could be $10,000, who knows? But yeah, I would probably try to push that out until that credit card debt was paid off.
Yeah. I know somebody that was at a credit union, and he was telling me about this guy who made like $70,000 a month. And they were on the fence of whether or not they thought about declining him on whether or not they were going to approve him for this car loan. He wanted, I think it was like $100,000 or $150,000 loan for an Escalade that was all tricked out or whatever. The guy makes $70,000 a month. Anyway.
Yeah, you kind of see a little bit of it all.
Yeah. All right. Next, he says, would like to do a syndication in the near future. Nope. Sorry. Again, I don't think you're ready for it yet. And if you go back and listen to the episode that we did with Cashflow Rockefeller Prince about being an accredited investor or not, and syndication investments for those that are accredited versus non-accredited, that's something to keep in mind. So if you haven't checked that out, you may want to check that out. But quite frankly, I don't think you're ready yet. I think we need to worry about building up the rental reserves, paying off the credit card debt, all that kind of stuff first before getting into a syndication. And maybe going back to what I said earlier, and I don't know how you feel. You didn't really indicate in your email about how you feel about these properties. Is it something where, you are enjoying managing them? Okay, fine. But maybe you fucking hate it and you just don't want to deal with it anymore. Okay, well, maybe if you were to sell one of them, for example, you would have the capital to then deploy into a syndication. Not a recommendation to do that, not advice to do that or not do that. You got to do what works for you, but just something to think about. So there's that. Let's see. Any thoughts on the syndication?
Like you said, I mean, I want to do it regardless, but I think that Big Brother K, down the road, is it possible? Yeah, in the near future, I would say doubtful without, like you said, getting rid of some assets that he has now.
Yeah. Okay. The next thing he has on here, want to buy a condo in the Caribbean/Mexico for both rental and personal use. Will take 401k loan to fund the down payment. I'm going to let you start.
I would advise against that. I think that where he is at right now, he has plenty of debt, and if I were in his shoes, taking on more debt right now would not be something that interests me, unless he is expecting some influx of cash, which it sounds like he's not, since he'd be taking a loan from his 401k. I would probably let the 401k be and let it ride, and not be taking a loan from it right now.
Yeah, I would agree with that. Although if you ever do buy a condo in the Caribbean or Mexico, we love going down to Mexico. Hook us up with a deal if you get into the short-term rental game.
Yeah, I could use it for a week or two.
Yeah, so we'll pay you some good money on it. And, don't forget those that did a podcast for you there that one time.
We'll take good care of it too over there. You probably won't even have to pay to get it cleaned after I leave. I'll keep it so clean. That's true. You might even have a bidet installed by the time he's done. Yeah. I need a bidet installed for me to stay.
So yeah, I don't know. But your next question, easy answer, I think, is yes. He said, do I need a tax advisor? I would say yes, because you have the RSUs, restricted stock units, which can be complicated. You have the rentals that you already have. You're talking about entering into syndications, which creates a whole storm of K1 bullshit. And then even if you say, fuck you, Cashflow King and Cube Crusher, I'm buying the damn condo in the Caribbean and Mexico, now you're all of a sudden investing internationally. So you put all those in a blender, and I think absolutely you probably need a tax advisor if you don't already have one. That's just my opinion, but ultimately that's up to you.
Yeah, I would agree with that. He's probably in the 1% of people that I believe actually need somebody to help them with taxes.
Yeah, he has a lot going on. You know, you said recently married, right? You have your stepchild, so there's a lot of things there. Not that those would be overly complicated, but I mean, you put all that together with all the stuff I just mentioned, and I would say yes, you probably do need somebody. His last question or statement was, where should I deploy my IRA cash? I am rebalancing. And my note just said, not in cash, exclamation point. I think we covered that previously. You can do whatever you want with it, but I probably wouldn't leave it in cash. But if you are going to leave it in cash, then do what Cube said and consider putting it somewhere to pick up some yield. All right, so I had 9 big points for Big Brother K is what I put on my little outline here. So I'm going to rattle those off, and then I'm going to turn it back over to Cube and see if he has anything he wants to close with. The first thing was I said, and this is in no particular order, by the way. I just rattled these down as I was going through. Number 1, life insurance evaluation / needs analysis. We talked about that. Number 2, disability insurance. That didn't come up at all. I would assume you have some through work, but I don't know. So make sure that you are covered in some way, shape, or form there. Number 3, rental evaluation / rebuild cash. And I mean specifically on the business side of the balance sheet. Number 4, invest your IRA cash. We talked about that. Number 5, tax advisor search. I think you should consider starting to, if you're going to get a tax advisor, potentially search for them now, especially going into the fall and even end of the year, because the last thing you want to do is wait till you start getting tax forms in January or February of next year and then try to seek somebody out, because all the good ones are going to be too busy with their existing clients to take you on. So I would start that sooner rather than later. Number 6, estate planning documents. There was no mention here about, things like wills and POAs and advanced medical directives and, trusts or anything like that. I don't know what your affairs are, how they're structured, but especially now that you're newly married, if you have documents in place, awesome, but you may want to reevaluate or think about reevaluating if you haven't done that already, and get any updates or revisions drafted as needed. If you've never done them before, it would be a great time to start. So I would seek out an estate planning attorney to do that. Number 7, credit card debt. We talked about that. That $14,000 and change was a little bit alarming, so we want to make sure we got that under control. Number 8, HELOC evaluation. We talked about that when we talked about the rentals. And number 9, rethinking your Social Security plan. We talked about that when we covered Social Security and the retirement income planning portion. Those are my big points, my big 9 for Big Brother K. Cube, what do you got?
I agree with all those. One thing here that you didn't talk about was his last questions about maximizing his cash positions. We kind of talked about those. Does he have too many? Yes, he does. And then the last question, do I have enough emergency savings? I know we talked quite a bit about it as far as the business side of it with the investment properties, and definitely not having enough. And, I think honestly, once it gets a little more consolidated as far as his accounts and things, he will see, how comfortable he is with his cash position. Personally, it seems to me, I don't know if I would be completely comfortable with it, especially considering the amount of debt that he has right now. Of course, I know that part of that is within the investment property side of things, but also there's always a chance that the investment property side of things was going to need emergency savings from your personal side as well. You hope that doesn't happen, but it could happen. So just something to think about. I know he has, $30K emergency fund plus $4K there, and then another $4K, so $8. So he's got about $12.5 that's kind of sitting there that's not technically in his emergency fund. So he has $12.5 plus $30,000. So he's got about $42.5 that is sitting there. I guess we'd call it liquid money outside of the investment property. So that's something to keep an eyeball on. I would maybe want it a little bit higher, but that's kind of up to Big Brother K, especially since part of it is invested as well. We got 24K of that 14 or 42.5, so 18.5 of it's not invested and is probably cash, which is a healthy cash balance. But that combined with the low cash balance on the investment properties worries me just a little bit. Might keep me up at night.
Oh, it scares the shit out of me, dude. I mean, spoiler alert here. Sorry, I got to interrupt real quick while I'm thinking of this. And I'm gonna do a podcast about this when it's all said and done. But we got an email. One of our cash flow crushers. We had our first turn. We knew the resident was moving out. It was like a Friday afternoon, like right before 5 o'clock, and we get the email from the PM that says, "Hey." Basically, and I don't want to spoil this because I'm going to do an episode on this, but sorry to be the bearer of bad news, but the property was vandalized. Somebody broke in, stole the water heater. We had flooding in several of the rooms because the water heater was in the attic, and yeah, it was a fucking shit show. So we get an insurance claim going, and the PM's dealing with them, and I'll get into all the details on the episode. But the point is, you just never know what's going to happen. How would you feel if you got an email or a phone call that something like that happened in your property and you're sitting there with $8,000? You know?
Yep. Stay away from real estate, people.
No, that is not the answer.
That's the answer. But so I would focus on that, and especially with this $14,000, and he knows whether or not that's just sitting there and how long it's been there and what exactly is going on with it. Like you said, the student loan I wouldn't worry too much about, but yeah, you may want to consider beefing up your cash position because yeah, you got IRA cash. That's not really real cash though. I'm talking as far as liquid. So That's what I would be focused on if I were him, figuring out these investment properties, getting them a little more profitable, maybe trying to build up the cash that's sitting there with those while subsequently building up some cash with your personal accounts.
Yep. All right, very good. Big Brother K, hopefully that was helpful to you and all of our listeners. We appreciate you writing into the show. We hope you enjoyed today's episode. Everybody feel free to share this show with a friend, family member, coworker, whomever, person on the street. What'd you guys think? If you like the show, give us some feedback. You can send us a text. I actually changed the text of it. Instead of saying send us a text or text the show or something, I think I put it in all capital letters. Text the Cash Flow King. There's actually a feature if you click on your show notes now. You can click on that and send a text message, and we'll actually get it. I'll get it in the app, and then I'll respond to it in audio format on an upcoming show. You can also write the show, realtalkpersonalfinance@gmail.com. Leave us a rating, a review. 5 stars is appreciated if you feel like we've earned it. And I thought this was pretty fun. So hopefully you guys enjoyed it. Feel free to send in your stats if you want to. Maybe we'll do it again. Not advice. And that's about it. You got any final thoughts?
Nope.
All right. Very good. We will see you in the next episode.
Check the mic and make sure it sound right, boys.